If you've got a limited company, then dividends are something you need to get your head around. Stay tuned and we'll tell you everything that you need to know. Hi, Nick here from First Formations. Dividends are how you take profit out of your company once corporation tax has been paid on it. They're paid to the shareholders, who are the owners of the company. There are two types. You have interim dividends, which are paid at any point during the financial year, and final dividends, which take place at the end of the year when the final accounts have been put together. Both have different approval procedures before they can be paid, and unlike salaries, dividends are subject to dividend tax rather than income tax. Let's take a closer look at this. A dividend can only be paid out of what are called distributable profits. That is, the profit that's left over after corporation tax has been paid. If your company doesn't have enough distributable profits, then you will not be able to pay one. The payments themselves are made to the shareholders, so only people who hold shares in the company will be able to receive dividend payments. In general terms, the shareholders will receive the proportion of the dividend to match the proportion of the shares that they own in the company. So if you own 100% of the shares in your own company, you will receive 100% of the dividend that is paid. Now, as we said, there are two different types of dividends, interim and final. Interim dividends are those that are paid at any time throughout the year, whilst final dividends are paid at the end of the financial year once the final accounts have been drawn up. An important difference between these two types of dividends is how they are approved. Your company's articles of association will set out the approval procedure, but most companies use the model articles, and in these cases, director approval is normally needed for interim dividends, whereas final dividends usually require the directors to recommend a dividend first and the shareholders to then approve it. Now, let's look at the process for paying dividends in a little more detail. Following the correct process is really important, even if you are the only person in your company. Firstly, the directors should confirm that there is enough distributable profit in the company to actually pay a dividend. This should be checked against a set of accounts rather than just checking what's sitting in your bank. Next, you need to get the right approval. As we said, companies using the model articles will normally just need the directors to approve an interim dividend. For final dividends, the directors recommend an amount, and it's the job of the shareholders to then approve. Third, you should issue a dividend voucher to each shareholder receiving the dividend. This voucher acts as a receipt and includes things like the amount received, the date of issue, and a signature from a company director. Finally, once this is all done, the payment can be made. Usually this is carried out by bank transfer, although other methods like cheques are normally permissible. When it comes to tax, the person receiving the dividends will need to pay dividend tax on the amount that they receive. For the 2026-27 tax year, basic rate taxpayers pay 10.75%, high rate taxpayers pay 35.75%, and additional rate taxpayers pay 39.35%. There's also a dividend allowance of £500, which means you won't pay tax on the first £500 of dividends that you receive. Now, dividends are just one part of staying compliant as a company. Between registrations, filings, and everything else that Companies House and HMRC expect of you, it's easy for something to slip through the cracks. Our hassle-free compliance service helps take care of your ongoing obligations so you can focus on running your business. Check out the link in the description below if you'd like to find out more. That's it for this video. If you have found it helpful, give it a like and make sure you're subscribed to see more just like it. And we'll see you next time. Cheerio.